You could go after a bear market, you could go 5 to 10 years or longer with no returns. For some reason, investors are panicking today. They're dumping shares. That's what this indicator tells us. On the New York Stock Exchange, everybody who got out with me on this target, because it was a pure technical trade, that was our target, get in, get out. Everyone had FOMO at this point. Everybody's like, why did we get out? I have to get back in. And tons of people got back into gold because they thought they were missing out and it was going to go to the moon. And now here they are underwater.
It's a big down day in the markets on Tuesday, November 4th. The S&P is down 1%. The Nasdaq's down about 1.6%. Gold fell 1%. Bitcoin's down almost 6% intraday. And Treasury yields, long-term yields are down as well. And so is gold and oil. I mentioned gold. We have Chris Vermeulen back to talk to us about what's going on today and what's next. He is the chief market strategist at thetechnicaltraders.com. Check out Chris's last interview with me when we talked on the day gold fell 6%, the biggest drop in about 3 decades, single day drop. And once more, gold is falling, and we'll talk about gold and stocks. Welcome back to the show, Chris. Good to see you again.
Yeah, thanks for having me, David. Always a pleasure.
A couple of developments. So today, the job openings in October were really bad. So employment opportunities hit the lowest level in more than 4.5 years as October came to a close and the government shutdown drags on. Job postings index fell to 101.9 as of October 24th, the most recent point for which data is available. That's the lowest since February 2021 for a measure that uses February 2020 as a baseline value of 100. Now, that's one piece of bad news. I don't know if that's causing it. And then on the other hand, we've got big banks. You actually brought this to my attention offline. Goldman Sachs, Morgan Stanley, overnight last night warned of a major correction. So it's likely there will be a 10 to 20% drawdown in equity markets sometime in the next 12 to 24 months, as Goldman Sachs CEO David Solomon at the Global Financial Leaders Investment Summit in Hong Kong. Things run, then they pull back so people can reassess. Kind of like what you've been saying, we'll get to that. A 10 to 15% drawdown happens often, even through positive market cycles. It's not something that changes your fundamental, your structural belief as to how you want to allocate capital. So I don't think he's warning of a major financial calamity, just a pullback. Anyway, I don't know if these things are causing today's sell-off, but we can assess what's going on right now, do you think?
Yeah, I think it is a combination of things. Obviously, the jobs number is a little negative. I think the two banks coming out, kind of two of the biggest banks, kind of when it comes to people giving analysis from those banks, they were bearish. So people listen. Although you got to take it with a grain of salt. It's, pretty high level stuff. A 10% pullback over the next 2 years is not a whole lot to go off of. We kind of have that we have a 10% correction every year, if not larger. So I think the markets are a little frothy. When we look at the charts over the past couple of weeks, really, we saw a big pop. We saw a couple big gaps up on the NASDAQ. We saw the Magnificent Seven breakout. We've seen the stock market really have some. I'm not a big fan of price charts when they have gaps. So if I was to share my chart here, I'll show you what I'm seeing here. Now, if we take a look at the SPY, and this is the same with the NASDAQ, we had resistance through here, and the market loves to gap above or below resistance levels or support levels. So it gapped above it, and we've got this gap window. Then we had another big move higher as it broke out. I think a lot of people were watching it. They jumped in, and it's created this momentum. And gaps tend to get filled in the market, David. And so the market has come down, and now it's trying to fill this previous gap and test this breakout level from about a week and a half ago. So this is a perfectly normal move in terms of how the market unfolds. We saw a pullback, we saw a little bit of a bounce, and now it's pulling back into support. The thing is, people today are actually really nervous. This is Tuesday as we're speaking here. We actually have some panic selling in the stock market. It's not like a huge sell-off, but our indicator here, when we look at the stock market tools that I use, we actually have some panic selling going on in the market. So I have this panic selling indicator in this top, this green indicator here. Typically when it gets over these levels and this blue line, we usually see the market put in a low. So we had panic levels hit over here. We had panic this morning at the open as we were talking. We're starting to get back into a panic territory. Typically after that, we see the market kind of rebound. The other thing from a short-term analysis is we have these lime green bars. And if we were to zoom back on the chart, lime green bars are typically seen as an oversold market condition. It means the market's sold too quickly. to the downside, and usually bargain hunters come and step back in. So the pullback that we're seeing is completely controlled. It's very normal. Yet, for some reason, investors are panicking today. They're dumping shares. That's what this indicator tells us. On the New York Stock Exchange, there's 3 people hitting the sell button to every like 1 person hitting the buy button, meaning people are dumping shares on the bid. They don't care what price they get out. They just want out. And when 3 people are running for the door to every 1 person who's waiting to buy, that tells us there's short-term sentiment shift. So really, the markets still are in an uptrend. This is nothing more at this point than just a pullback, and we're just kind of letting the markets kind of correct after this.
Just a few points here. I'm going to share my screen real quick. This is the S&P 500 heat map. As you can see, not every company in the S&P 500 is down. There is a big tech sell-off today, led by Palantir, missing earnings, among others, and of course, these tech companies that occupy a big percentage of the S&P 500, they're dragging down the entire index. But it does feel like a broad-based sell-off. As I mentioned earlier in the introduction, Bitcoin and gold are selling off. They have nothing to do with the S&P 500, of course, as you know. And so when you mention your panic indicator being triggered, what does that mean exactly? How is the panic, quote unquote, defined in your indicator?
Yeah, so the way I define panic is more or less, it's taking the New York Stock Exchange volume, the up volume and the down volume. It's just a ratio. You divide them into each other. And more or less, it's telling us, so I use the New York Stock Exchange volume because it's known as the big board. The big brands are in there. If you were to go ask an average investor, like pick a stock, it's probably in the New York Stock Exchange. And so I use that volume as that mass psychology. When we see everyone selling shares on the bid, they're just market order, get me out on the New York Stock Exchange. That's usually telling us the general public now has reached a tipping point where they just want to get out of their trades. They think everything's falling apart. And it's the same. We have one for the FOMO indicator as well. The markets can rally, and the market can actually have everybody running in and buying stocks, and they don't care what price they pay. And that's the red indicator that I share on my chart when you and I do this. So it tells us when the market is, these extreme of short-term overbought, oversold levels and the panic selling and FOMO, they're just short-term extremes in market sentiment. And they give us an idea. Like today, for example, while most people are panicking and selling stocks, we look at it as, hey, the S&P 500 has pulled back to the 20-day moving average. It's had a nice 3-wave correction, or a little bear flag, down to support. It's testing the breakout. It's a gap to the downside, and there's panic selling. And all these things actually say, while everyone's panicking, we're like, oh, this is nice. This is actually like kind of a buy the dip mentality. If you're a momentum trader, this is where you'd step in and look for kind of, you buy the dip and you sell the rip. So we could see a big pop and rally over the next 1 or 2 or 3 sessions and create this momentum. So that's how that indicator is done. It's just pure volume flow on the New York Stock Exchange.
Most people use VPNs or encrypted apps to protect their privacy, but the real vulnerabilities happen and lie much deeper at the cellular level. Traditional carriers have been caught selling user data or getting hit by breaches. That's where our sponsor, Cape, comes in. Cape is a secure mobile carrier built by experts in telecom and cybersecurity that prioritizes privacy above anything else. They don't ask for your name, social security number, or address. They delete call metadata after 60 days, and they have a commitment to never sell your data. It also protects against SIM swaps by giving you a private key phrase that only you control, similar to how crypto wallets are protected. And it encrypts your voicemail so no one else can access them. What makes Cape special and unique is that it is the only privacy-focused mobile carrier in the country that runs its own cloud-based mobile core, which gives it more control over what security measures are implemented. Go to the link down below in the description or the QR code here to scan it, and use the code DAVID for 33% off of your first 6 months. Yeah, we'll get to your positioning in just a bit, but take a look at my heat map one more time. You see it's mostly AI stocks down. Nvidia's down almost 3%, Oracle's down, and Oracle missed earnings as well. I mentioned Palantir earlier. And if you look at Apple's up, for example, Walmart and consumer defensives are good, healthcare is in the green, financials are all in the green. It's mostly tech that's leading the charge downward. It does feel like expectations for these tech earnings are being placed higher and higher every single quarter. At a certain point, they're going to miss expectations, and that's when we get a big sell-off, kind of like what's happening now. Do you think then that this inflection point for tech is almost upon us, meaning we've reached the point where expectations are almost fully met, if not already exceeded. And then things are going to start to get disappointing for investors going forward. And that's when we see the market correction.
Yeah, I do. I do think I think people are getting numb to like Nvidia, big returns, big growth. You mentioned the tech sector. If we look at the XLK down the tech sector here, it's down pretty sharp. It's down 2.25%. But when we look at sectors as a whole, like here's about 40 different sectors, you can see most sectors are down today, and they're all down pretty much 1% or much higher. As you said, David, I believe it is a little bit of a broad market sell-off. People are nervous, and when people get nervous, they tend to liquidate everything. And even if it's something that should be in favor, like precious metals or miners, they just tend to sell everything. And this is a good sign. This is generally telling us that this is a kind of a tipping point. Once the masses kind of release their shares into the wild, into just they exit, usually the market wants to turn around. And the amount of sectors on our hot list here, they're pretty much all negative. We have a large group of them with all kinds of short-term downtrends. I think we're going to start to see this market kind of carve out a bit of a bottom and try and figure out a rally. I think the stock market is in for a rough ride. I think gold and silver are primed for kind of to benefit the most over the next month or two. Seasonality wise, when we look at the markets, if we look for the stock market here, typically from the beginning of November to the middle of November, the stock market struggles a little bit. So that's right where we are. We actually saw the market push higher going into November, and now it's starting to pull back. If you look on the chart, we had a run up into November, and now it's starting to pull back. So seasonality seems to have its claws into the stock market. If we look at gold, it's kind of the same. Gold kind of holds its ground and struggles. And then, of course, it still has more pressure into the middle of November. So I still think we're going to see a little bit of profit taking, a little bit of panic selling for the next more so 10 days or so, 7 to 10 days. And then we're going to have a tailwind behind us for the precious metal space and the stock market as we go into that holiday end of year rally.
Look at these comments on our last interview. I love reading through the comments. We had you on October 21st, so that's the date gold dropped 6%. We were talking about comparing now to 2008, which we'll talk about in more detail today, by the way. And people should check out Chris's last calls just to, keep tabs on what we've been saying. He comes on regularly on the show. Anyway, Chris again here. This guy is the Canadian Jim Cramer. I don't know what that means. You are the Canadian clown. Okay, is that your alt account? Is that one of your burner accounts? Dude has called 84 of the last 0 drawdowns. Gold is still above 4K, pretty good. 100% cash. This guy is paying tax like crazy every time he sells. Now, that's interesting. We can talk about that. This is not applicable to the average investor who should not be paying 25% tax on any gains every week or a few months. What's he referring to?
Well, I mean, if you trade like say the QQQ in and out all year, at the end, it's not like you pay 25% tax on every single gain on every trade. If you have say 10 trades in the QQQ and you have a net profit at the end, whatever the net profit is, you do have to pay tax on it. It's not that you pay that on every single trade. So it's at the end of the year, are you net profit, like a net profit or loss for your investing, and then you pay tax on that. So it's not on every trade. That's just, I think that's just confusion there. And of course, this is where I see things differently, right? People don't want to pay tax. The reality is, if you pay tax, you are making money. And there's two big taxes here that most people don't seem to grasp or take into account. One of them is, you could go after a bear market, you could go 5 to 10 years or longer with no returns. The tax there is time. You're literally wasting potential returns. You're wasting time, which is the most valuable resource we have. The second is, if we go into a bear market and your account falls 30 to 50%, especially if you panic out of it, you just paid a way bigger tax than 25%. So I would much rather navigate the markets, pay taxes on gains. I don't hold things as they collapse or fall. The focus is to really focus on holding things going up or moving to cash and earning interest on the sidelines while the market falls apart. So that's kind of the way I see the whole tax side of things.
Okay, let's address some of these comments, though. Why are you always bearish?
Yeah.
According to these comments, I'm not saying it's for me.
No, I think it is true. I mean, I'm always bearish in my opinions because I guess I'm very risk focused. I'm always like, things could fall. The market, when you put your money into the market, it is naturally trying to take your money from you. As traders and investors, we're competing against other traders and investors. And when one person wins, somebody loses. So
No,
my
but you
whole
do see how it's kind of confusing to some people when, let's say, your overall thesis is bearish, but then you're maybe 100% in the stock market at certain times, or you're long, where in this case you're thinking,
yeah.
gold is a good buying opportunity, which we can talk about. The stock market dip is a good buying opportunity, which you just talked about, right? You can see how that doesn't add up to some people. Like, how do you explain that to somebody?
For sure. So think of it a child or somebody getting their driver's license, right? If you take driving ed, then they learn to do defensive driving. You check your mirrors every 3 to 5 seconds. You're always gauging what's going on, right? That's what I do in the markets. I'm constantly looking around. All I see is potential chaos. And that's why I have my bearish, like this could collapse, this could pop, this is going to happen. And so I constantly are sharing that. The big thing is, you'll put a bearish, thumbnail, and I'll put bearish thumbnails on my channel. And people naturally just skim the titles and they come to a conclusion. And the reality is, if they listen to our talk, yes, I'm bearish. I think a lot of bad things could happen, but I always explain, like, we're long the markets here, even though I do think, that things are coming. So there's a huge difference. I mean, this is also part of the problem of, I share analysis and things publicly, but the investing and the actual trades and stuff is for investors who I work with. So I share the analysis and are we long, are we short, what do we own in the overall trends, but I can't give the exact details of every position we're in. So people kind of have to piece that together at some point, right? So it's I'm always looking for problems and making sure you're mentally prepared that something bad could happen. And more important, or equally important, is you need to have an exit strategy for when it rolls over. And so we get in and we get out of the market, because you never know when one of the corrections are going to turn into a big sell-off. I mean, if you go back and you look at the big sell-off earlier this year in the stock market, this is the QQQ. Our strategy told us to get out, then we go into this massive sell-off. And then eventually, we got to avoid all this and we got to buy back into the markets at a lower price and then ride it higher. And, one of the comments was something like, this guy doesn't know jack shit. And he says, he said not to buy after Liberation Day. Well, the reality is we did buy after Liberation Day, but we waited until it went from a bounce to a trend. And so I don't just buy after a huge sell-off, because that big sell-off might not be the bottom. It might continue to sell off. And of course, if it did, then whoever bought trying to pick a bottom is going to get absolutely slaughtered, and they're going to be underwater for years. So, it comes down to just understanding the strategy that I have. I'm all about protecting capital. I'm not swinging for the fences trying to make money on every single bounce and drop. I'm trying to identify these waves. When a swell or a wave comes to an end, I want to get out. I want to go somewhere else. When a new wave starts, I want to get in and I want to ride it. It's much slower, 5 to 12 trades a year. I think a lot of people are very active traders and they see short-term signals, and I avoid those, because it gets you into a lot of noise and a lot of volatility.
Can you please pull up a comparison chart between now and 2007? Was it 2008 or 2007 that you have the comparison chart? I think it's 2007, right?
Yeah. So this is 2007 stock market top. The yellow line is gold. Is this the one you're talking about?
Yeah, let's do that.
Okay. Yeah. So what I find interesting here, and you and I have touched on this, is the stock market was making an all-time high back in 2007. Gold, the yellow line, was pushing up to all-time highs. And then finally, we started to see the stock market struggle a little bit. Gold started to pull back. I kind of believe we're in a similar situation in terms of price action. We've got gold pulling back. There's a little bit of fear in the market, very similar to what we saw just over here in 2007. And what's interesting is, if we look on the left chart, I've layered in multiple different assets down below. So we have GDX, which is gold miners. We got silver, platinum, and palladium. And this is what I've been talking about for the last little while, is everyone's been piling into gold. It became a short-term crowded play, which is why we've got this initial little pullback. But you can see that in this chart. When we look at what people have been doing with gold miners, with silver, with platinum, and palladium, money's been moving into this space. So whoever's open to the concept of holding physical metals, they have been piling in. It's been a little bit of a feeding frenzy. Things got a little overbought. When we look at what happens after this, we tend to see the yellow line, gold, shoot dramatically higher, rallies about 30%. The stock market ends up struggling. So I think money pulls out of stocks. Money's always looking for a return. So it's going to move to whatever's got momentum, which is gold. It's also going to be miners. It's going to be silver, platinum, and palladium. So that's kind of where I think we are right now. If we look on the similar chart of where we are, you can see if I was to just kind of move 2007 back, we're in a very similar situation. All of these assets have come to life. It's become the crowded play. We're having the first little pullback and pause. And then I think we're going to see gold in the precious metal space shoot higher fairly dramatically. I think gold's going to go to 51, 5,200. Silver is going to shoot higher. I think that's kind of where we are. We're right in this cusp of just the last month or two where I think gold and the precious metal space have one more big run. And the big question is, does the stock market stall out and the money coming out of equities, does that get pushed into precious metals to create this giant rally? So that's what we're just kind of waiting to see.
Gold miners have fallen substantially as well. And last time this happened, the gold miners continue falling even when gold stalled for a bit. Do you think miners, in particular equities, overall are a leading indicator for the metals, or the other way around?
Sometimes they lead, sometimes they don't. Precious metals and miners kind of have this weird relationship to each other at times, and they also can decouple from how they move with the stock market. Sometimes they move with, sometimes they do the opposite. That's what creates a big wild card when it comes to trading the precious metals space. You just don't know if it's going to move with or against the market or the opposite direction. I think gold miners, like we got into this whole kind of little bit of a feeding frenzy phase, same within gold and silver. A lot of people moved in right up into this phase. And so now when you have emotional money moving into the market, when it does reverse, you have emotional money moving out, meaning you usually see everybody pile in at the same time, and then they all kind of bail out and sell off. And I think there's a lot of fear in this market. And I think that fear is causing a trickle effect of money flowing out. And gold kind of shows it in a little bit more of a kind of a relaxed way. It's not moving quite as dramatic as the miners, but overall, it's just an unwinding of events. So for example, gold had hit our measured move right over here. We ended up playing this really nice trade to the upside on this breakout. And then after that, it went into this kind of bubble feeding frenzy mode. And everybody who got out with me on this target, because it was a pure technical trade, that was our target, get in, get out. Everyone had FOMO at this point. Everybody's like, why did we get out? I have to get back in. And tons of people got back into gold because they thought they were missing out and it was going to go to the moon. And now here they are underwater. And now I actually like gold here. And everybody's like, why do we want to get into gold? It's reversed, it's selling off. And so these are these important like turning points. When everybody wants it, you don't really want it. And when nobody wants it, especially when it's in a super bull market like gold right now, that's usually marking a low. So I think gold is trying to find a bottom here. I think we're going to see that happen fairly soon because everybody seems to be bailing on their gold miners. As you said, they're moving out, they're selling off, and they're kind of giving up on it. And I think we'll see a bottom potentially this week in the precious metals space. And miners are down the most because they're kind of this very liquid. They're not very liquid in terms of they sell off. They're a small market, and when people sell them, they drop quickly.
Gold's cap is like what, 27, $30 trillion. So that's the $30 trillion question right now. Is gold still in a super bull market, like you just said? Because like you said, not everyone, but it seems like people are taking profits. We're now below $4,000 again. It's been consolidating around $4,000 since October 25th. So about a week and a half now, Chris. Yeah. And it's just waiting for a pullback or a breakout. Either way, we don't know yet. But you're bullish and you're buying on the dip. Why?
Well, I mean, based on a pure momentum play, this is telling us based on the momentum of it in the pullback. Usually when you have the first pullback to a key moving average, like if I just go back to the daily chart, when you have a very strong run and rally, one that just shoots up and then you have an emotional kind of blow off phase, when it first drops back to a key moving average like the 50-day, generally it wants to have a bounce and it's going to want to go higher. This is just, even though it has pulled back and reversed to the downside temporarily, overall, this is just the first pullback within, I think, this major trend. So it's not so much a long-term investment. This is like an active trade. We're looking for it to run up to about 5,100. And again, what it's done is it's pulled back into a support zone. and sentiment is favorable for it to go higher because people don't want it right now. So it's just that support. It's oversold, and the underlying long-term trend remains up.
Right. Can you say the same thing for silver, the sister metal to gold?
Yeah, silver's doing much of the same thing. It's consolidating, a little more volatile. It is trying to carve out a bottom as well. We've got this potential little bit of an inverse head and shoulders. It's trying to build a potential rounding formation here for it to break and pop to the upside. It's nice to see actually silver holding up the way that it is. Sometimes you see it really have some big red bars to the downside. But again, I think they're going to move more or less in sync together. I think the metals are holding up better. They're not making lower lows at this point. They're not breaking the lows from about a week ago. And that's, I think, because they're not connected to the stock market. The stock market is pulling back. Gold miners are stuck in the stock market. And as you and I have talked about, I look at the markets like the ocean tide. When the tide goes down, all boats go down. So if the stock market tide is going down right now, and you got a gold miner that's stuck in that tide, it's naturally going to have more pull to the downside. Whereas gold and silver are a commodity, they're not even connected to the stock market. And so they're holding up better because they don't have that falling tide with the mass psychology of everyone kind of dumping stocks and selling. So I think gold miners are telling us what the sentiment is. People are panicking, they're selling and moving out. And I think it's telling us, and gold and silver are holding up. So I think it's an emotional pivot low, and I think we're going to see the market carve a bottom out if it's not already in for gold and silver here.
And let's move on to Bitcoin now. Like I mentioned in the beginning, Bitcoin is also down on the day, 6% drop, pretty big for Bitcoin, even for a volatile asset like Bitcoin. It's now down to $100,000, which I believe is the lowest point in months. Let's check it out here. Bitcoin chart. Yeah, exactly. And like I mentioned, it's interesting because the sell-off from stocks understandably comes today from the missed earnings of a lot of these AI companies, but that has nothing to do with Bitcoin and gold. And yet all these risk assets are selling off. So I'll let you comment on this.
Yeah, they're all kind of connected. Like as soon as Bitcoin got like sucked into the financial markets, became a future, it's now stuck with the ebbs and flows of the stock market. So, as if the Nasdaq sells off, usually Bitcoin's going to sell off. It's the same group of people now that hold it when it's not like the Wild West anymore, where it's outside of those markets. So now it's really stuck in. Other money's pouring into risk on assets, or it's coming out, and Bitcoin is now kind of stuck in that. Now, the daily chart pattern here is pretty ugly. We got this megaphone chart pattern, which is a series of higher highs and lower lows. This is a broadening formation. Breakouts to the upside are get sold into. New breakdowns get bought back up. So this is a pretty ugly chart. And when we draw a line just across here, you can see it's really just kind of stuck at resistance. It finds this level here and gets rejected down. You don't really want to touch anything in a broadening formation. It means there's increased volatility, higher risk of it failing, and of course you have bigger potential losses. So again, like right now, it's had this huge sell-off, and this pattern is so unpredictable that it could very easily be back up at $128,000, dollars of Bitcoin a month from now. And I'm not saying that's going to happen, but that's what this pattern shows. It's very unpredictable. If we zoom back on the pattern, you can kind of see a similar type of move here where we have this kind of little bit of a broadening formation. It kind of gets pretty noisy. You could argue it's more so a double top. I feel like where we are right here, where we are right now is kind of over here. I think it's going to be a rough ride. It's going to try and stabilize. I think a lot of people that got into this whole phase right through here, I think they're going to get shaken out. The market is probably going to gun to break this 98,000 or 99,000 level and try and get all of these investors through this whole time to bail out. That's what the market loves to do. Just like over here, it breaks down, it stabilizes eventually, and then starts a new move up. So I think we're going to see Bitcoin continue to flounder and struggle going forward. I wouldn't bet on the downside. Again, this pattern shows that it could reverse and have a huge rally. That's why you don't want to mess with this type of pattern. It's very unpredictable.
It's interesting because Bitcoin is basically flat on the year. If you take a look at where it was trading exactly in the beginning of January, it was like roughly around $100,000. Bitcoin reached $100,000 first last December, I believe, late November, early December, and I just noticed that it has underperformed the Nasdaq which is up 21% year to date. And in past cycles, whenever we have pretty good performance in the stock market, especially the NASDAQ, Bitcoin has usually outperformed. It's like silver outperforming gold in bull markets, which it didn't do in 2024. It started doing that this summer. Bitcoin is not outperforming stocks in a bull market. And I just find that a little bit interesting. Can you explain what's going on? Have investors have just moved away from the crypto space and moved on to AI stocks? Is that no longer a love trade right now in 2025?
Yeah, based on my sentiment, I do feel like Bitcoin's lost its shine. I think, Ethereum got some good traction, really took a lot of focus away from Bitcoin. Gold's back to life, and gold, silver, and miners. I think a lot of people who are in the crypto space were and are gold bugs, and of course they want to move to what's working. And I think, we've heard people saying $1 million Bitcoin and $500,000 Bitcoin for how many years, and the charts are just getting uglier and more, unstable. So I think people are giving up on it to some regard, and it's just not the focus right now. People move to where the money is and where the trends are, and Bitcoin just doesn't have that right now. So, yeah, you can feel it. There's just the sentiment. I usually get lots of emails and questions on this stuff, and people are more so wondering, like, there's not interested in Bitcoin. They're wondering where else to go. And yeah, so precious metals has got the pretty much all the focus here.
Going back to your panic indicator, when that triggers and flashes red, is that usually a buy opportunity the day after or the day of?
Yeah, so the way it works is when the green, I have green as the panic selling indicator, because when we're in an uptrend, you want to buy dips, or you want to know where there's a pivot low. So when the market sells off and our panic indicator, our green one, spikes up, usually it's that day or the day after. So it depends on the level, right? So for example, when it breaks above 3, typically this day or tomorrow can be bought. Usually the market will have a bounce for 1 to 3 days afterwards. If the panic indicator actually closes at 7 or higher, that is a level where, if you go back on the charts a long time, it will usually be a standout low, meaning usually there's so much fear on the close of that day, the fear actually carries over for 1 or 2 more days. So the market can keep falling for 1 or 2 more days because everybody's just running to sell. And it usually takes 2 to 3 days for the world to kind of catch up, right? There's the day traders and the active traders like us who can take action the day something happens. And then you've kind of got a bit more of the working class who come home after work and they see it on the news and like, oh crap. And then they put their order in, they get out the next day. And then there's also people who are a little more lagged and they're like, oh, it's another bad day. Finally, they're going to get out. So depending if it's a very high level of panic, 7 or higher on the scale, then it's usually 2 days later or so, it's a very big buying opportunity in terms of the market being a big standout low on the charts. Yeah, it should be a lot higher. The market should be a lot higher after that.
Okay, so let's close off positioning. I believe last time we spoke in mid-October, you were all in cash. Correct me if I'm wrong. Are you still all in cash?
No, we got long back the markets. We hit our first target on the QQQ, and now we're just continuing to see if this equities market's going to move higher. So we're long equities here, and seeing if this trend is going to continue to the upside.
You got long when, Chris?
We got long right over here, right on this breakout move when the market kind of had a big gap up, and it was a broad market kind of breakout and move to the market. So this is where we got in. We hit our first target right up here at the near the high, and now it's kind of pulling back, filling, trying to figure out, taking one of these breathers. Hopefully we're going to see another run and break to the upside. Okay,
so you got long before it's high, but wouldn't a shakeout day like today change your positioning at all?
No, it's a shakeout day for those who are getting shaken out, right? Who are emotional. Okay. So for us, this is we want a shakeout day like this because it's telling us tomorrow we should probably see the market bounce and rally. And if we look at this chart pattern here, for example, we can just look at this last run, this move higher. This is the most conservative view. We can say, okay, well, based on what's happening, we should see the QQQ rally from where it is right now. It should want to push up about 6% to this next move. This is just this Fibonacci measured move. There's a few different targets. We could even go down to this low, and it shows how much upside potential there is in this equities market here.
Your website teaches us asset revesting. Tell us what that is and whether or not you address those comments where People talk about you always being bearish and predicting 13 of the last 5 crashes or whatever the comment is. But yeah.
Yeah. So asset revesting, it's really simple in a nutshell. I look at the stock market like the ocean. If you're in a bull market, you're in a rising tide. So you can just throw a dart at stocks more or less. If you're in a bear market, you're in a falling tide. So you need to know if we're in a bull or bear market. And then we break it down to looking at the stock market kind of like a surfer. When you see a surfer floating out where the waves break and they're waiting, what are they waiting for? They're waiting for a big set of waves to roll through every 5 minutes or so, right? And so that's what we do in the stock market. We wait for a big trend in the market to start. We hop on that wave. The nice thing about a strong trend is you can identify its strength. And the nice thing is once you ride that trend, you also know when it's starting to weaken. So we can trim off profits, we can lock in gains, move our stops up, protect our capital. And so I look for these 5 to 12 waves that roll through stocks, bonds, currencies throughout the year. And we just have these trades, right? It's pretty simple and straightforward. If you're a active trader, it's like watching paint dry. If you're a passive investor with an advisor, you're going to be like, oh, it's way too active for me. So we're in this awkward spot where people are like, it's too slow or it's way too active. But there's usually money to be made where nobody is. And so that's what I trade. And that's the struggle is people just don't get it. They don't see it. People who've read my book, Asset Revesting, our subscribers all say the same thing. I wish I found you 10 years ago. It makes so much sense. The markets are now comfortable. I don't care what happens. It's all about riding these trends in the market. Like when you come over here, our color-coded strategy, it's pretty simple. It tells us when to get out to protect ourselves. It tells us when to get in and take advantage of these trends in these markets. And we just move in and out of various assets. So it's pretty simple. We usually have 1 or 2 ETF trades open at a time. And we carry cash quite often because once we hit a target, we move to cash and we earn daily interest and dividend payments while we wait with that portion. So it's a pretty straightforward strategy. And I usually talk bearish because I've gone through a bankruptcy many, many years ago. I've blown up 3 trading accounts. I see this all the time. I've helped about 30,000 different investors over the years since 2001 with my newsletter. It's the same thing. People chase money. People are emotional. They put too much money into a trade and then it backfires and they do serious damage. They get into a winning trade and they don't want to get out of it because it's making money. Why would I get out? It's working. Well, they end up holding it until it goes down. And then they're like, well, now I'm just going to wait for it to come back, or it's dropped too much. I can't get out. So I just help people get rid of that. I'm like, hey guys, the market says get the hell out. We get the hell out, right? It's that simple. Just close the position. Let's sit on the sidelines or find something that's going up. And so I just kind of hold everybody's hand. I just trade my own portfolio and I share exactly what I do with subscribers. And whether you can follow it, you want to follow those signals or not, or modify them, you can do it. But it's literally red, green charts. Whether we own stocks or we don't, we either own bonds or we don't, or we're long the dollar index or we're not. It's really, really simple, but people seem to think they need to trade a ton of stocks and the fastest sectors and all that stuff. Usually that just causes more damage and wastes a lot of time and money. And to me, this is like the holy grail. We get just enough trades to avoid market crashes and corrections and still ride the markets to all-time highs every time they push up. And we don't have to, follow the markets that much. It's an end-of-day strategy. So we don't have any signal to the end of the day. It's not like we're not day trading or anything like that. It's pretty straightforward.
Great. All right. I'll put the link down below. Follow Chris in the technicaltraders.com there. And we'll speak again soon, Chris. Thank you for joining us today.
Thanks, David. Always a pleasure.
Yeah. And thank you for watching. Don't forget to like, subscribe, and hit that like button. See you next time.